Hi, I'm Jerry Levy, Managing Director of Texas Capital's Mortgage Securities Sales and Trading. Housing remains in a slowdown. The median age of new home buyers is now 38, which indicates the extent of the affordability crisis hitting first-time home buyers. And that is with 30-year mortgage rates down to 6 5/8 to 6 3/4 now. The move down is ironically due more to the mortgage basis tightening on reduced supply than changes to rates. Refinance activity picked up last week. Actually, it's significantly higher than a year ago, but that's based off of those very low 2024 levels. Tariff headlines and the signing of actual trade deals between now and August 1st are the focus post the passage of the big, beautiful bill that will increase the fiscal deficit. Interest rates and Fed cuts. Fed fund futures are still pricing in 2 cuts for this year and between 3 to 4 cuts for 2026, with year-end rates of 3.83 for this year and 3.12 for next year. And that's from today's 4.25 to 4.50. The June FOMC minutes highlighted why we are in this wait-and-see environment. 10 voters see 2 cuts in 2025, 7 see no cuts in 2025, and 2 see 1 cut in 2025. Christopher Waller and Michelle Bowman were the only ones who would have cut in July. Against this backdrop, we are seeing a historically unprecedented pressure campaign against Chairman Powell by the administration, led by Trump, who tweeted out over the weekend that Chairman Powell should, quote, resign immediately. FHFA Director Pulte added to his social media blitz, 100 tweets, by the way, just in June, with a news article on Friday saying that there are rumors that Powell will resign due to, quote, political bias and, quote, deceptive Senate testimony. And that refers, of course, to the Fed's building renovation. OMB Director Voigt added that, quote, Powell grossly mismanaged the Fed, while former Fed Governor Walsh said regime change is necessary and that, quote, it's about breaking some heads. DB strategists said this weekend that this unprecedented campaign, if successful, will undermine international confidence in U.S. assets, at least in the short run, and that this risk is being underestimated. One note, however, U.S. long-end yields, the 10-year and the 30-year near 5%, have outperformed in 2025 versus German, UK, and Japanese long-end debt. German debt is at a generational high in terms of yield going back to 2011, for example. Last week, we saw that the U.S. auctions went well. It can be argued that part of the pressure on our trading partners is the increased fiscal spending by those countries, which is in direct response to policy and tariff initiatives of the Trump administration. The USD 10-year has been trading in its tightest yield range in 3 years, and the 3-month 10-year vol, a technical term, is at a multi-year low. Domestically, the administration, as we mentioned last time, is behind the supplemental leverage ratio, the SLR reform for banks, which will free up existing bank capital to support larger investment in Treasury and Ginnie securities. Talking about Ginnie securities, banks have been the main buyer of CMOs earlier this year. There were $38 billion created in February. That declined to $30 billion in May and just reported $23 billion in June. It certainly will be an interesting second half of 2025. Thank you.